the Eurodollar market. It means an offshore market that's off balance sheet and off the regulatory radar. But when did it go offshore? We're going to ask that question of Jeff Snider, the head of global research for Alhambra Partners, as part of our investigation of the latest Treasury International Capital report, which is for the month of July, and what it may be telling us about the current state of the global monetary system. But first, we're going to go back in time. Jeff, how far back in time are we going?
We're going to go all the way back to almost the first couple years that the Federal Reserve was in existence. We're going to go back to the teens, the 19 teens.
Well, okay, so 1914, I think the Federal Reserve came into existence, or 13?
13 was the law, 14 was the first operation, 15 is when everything got going.
And then very quickly, somebody said, it's just human nature. It's human nature. You know, I mean, we try to contain human nature. Don't overdo it. Don't be overly speculative. Maybe we'll save these bubbles. We'll have a Federal Reserve to manage everything. And yet within a few years of this entity being created to try to moderate the vicissitudes of the, the private banking system, somebody in charge says, why don't we create a system that's sort of out of the way that can do things that we would otherwise not allow? Tell people what these EDGE Act corporations were.
Well, first, before we get to the EDGE Act corporations, there were agreement corporations. And before we got to agreement corporations, there was the British mercantile system, which I don't talk about in the article we're featuring here. But really, what one of the Federal Reserve's earliest jobs, not the one that had to do with currency elasticity, was to try to challenge British monetary supremacy, because at that time the United States was becoming the world's economic superpower, and it was widely believed that the US dollar should challenge the British pound in some way, shape, or form as the world's dominant currency. And it's kind of lost to history that some of the Federal Reserve's earliest tasks were to, for example, to create and nurture and maintain a banker's acceptance market, which is sort of an instrument of global finance, as well as what we're talking about here. A couple of years later, Congress got together and amended the Federal Reserve Act in 1916 and said, let's set up these agreement corporations. And what were agreement corporations? They were essentially private banks, really syndicated banks that would get together, raise $1 million in capital, and then be largely free of regulation, domestic regulation, so long as they promised their customer base would be non-Americans. So you can set up a bank in the United States, relatively free of regulation, pretty much do what you want so long as you don't do anything inside the US. And that was sort of the model or template that is familiar to anybody who understands the Eurodollar system today. It wasn't something that the template didn't just start in the 1950s and 60s. It actually goes much, much deeper than that, back to the earliest days of the Federal Reserve in the United States, which were, again, trying to mimic some of the late 19th century habits of the British mercantile system. So the Eurodollar's roots go way, way, way back in time. It's just that they weren't really exploited until that particular moment in history.
And these EDGE Act corporations, they existed literally outside the boundaries of the United States, here in the Cayman Islands, maybe in Nassau in the Bahamas. I know right now there's a special exclusive economic zone in the Cayman Islands where you're allowed to do many more things as long as your customers aren't residents of the Cayman Islands. And I'm thinking of the city of London in the 1950s. Same story, right, Jeff? We had all this financial repression in place after the Second World War to try to pay off all these debts. But it was said, all right, well, you guys can do all these extra things as long as you don't do it with any citizens of the, of the British Isles. But the idea, Jeff, is that there's a Chinese wall, a Great Wall, a firewall, some sort of barrier between this money activity and the one that's onshore. But guess what? Like Jeff Goldblum said in Jurassic Park, life will find a way, water will find a way, and money will find a way through these cracks into the national system.
Yeah, and I think that's really our point here, right, Emil? It's that this setup had been put in place a long time before, and basically nobody took advantage of it because at that time, in the 1920s and 30s, especially the 30s and 40s, offshore finance we're not high on people's lists of places to go with their funds and their funding. But when you get to the post-war world in the 50s and 60s, suddenly you have not just a rebuilding global economy. You also have dollars floating around outside the United States. You have the guts of an international banking system really starting to put together. And then you have technological and communications evolutions and innovations that make it really easy to set up a brass plate shell in the Bahamas or the Cayman Islands and communicate directly with that quote unquote offshore entity, even though the offshore entity that you've set up is nothing more than a name on a door. It's not actually a bank. It's just one of your employees who are lucky enough to be relocated to the Grand Cayman and enjoy the sun and take orders from the New York parent, even though technically, as you just said, Emil, there's supposed to be separation between these offshore banks and their onshore parents. Really, this really is a shell game, essentially, that moving around, trying to get around regulations and to move money and monetary capacities into their most efficient ways. Like rain or wind during a hurricane will always find the weak point in your house. That's really what we're talking about here. Money and finance will find the weak points in the system, and they will always try to exploit it, even if that weak point was set up 50 years beforehand. There's always going to be the right combination of factors put together at specific periods in time that lead to, as the Jeff Goldblum character in Jurassic Park was alluding to, chaos theory. It will lead to unpredictable and unimaginable consequences at certain times.
Chaos theory is one component of a wider field of study called complex systems. And we're going to talk about the most recent activity in the nodes of this complex system, what's happening in the Caribbean and Japan. But before we do, let's go back to the article, which I never introduced to the audience. By the way, it's called Dollar Warning Update from the Islands, which started it, posted on the 17th of September at Alhambra Partners. And Jeff, before you dive into what's happening right now, you continue by telling the story that this was happening in the background, but it was being studied, that there was good, honest scholarship being done. And I've got a quote here that I've got to read from Richard Debs. But before I do, people may be wondering, because I said there was scholarship being done. Something happened. You call it the Volker Myth, which ended this honest scholarship of this offshore, off the books, off the radar system.
Emil, it's one thing we talk about constantly, really, when we go back in our historical, examinations. The 1960s in particular were, because the Eurodollar system, this offshore monetary system, expanded so robustly and started to impact so many different parts of the global economy, even policymakers who had initially kind of turned their shoulder and turned a blind eye toward the Eurodollar system were forced to start to reckon with it. And so when these things started to happen in the 1960s that they could no longer ignore, big things going on in the monetary world, they did what they were supposed to do. They started, undertaking studies, examinations, talking to these bankers who were in the field. And there was a wealth of scholarship on the Eurodollar offshore money system, especially late 60s throughout maybe the middle to late 70s, where these central bankers took an honest look, economists too, academic economists took an honest look at what was actually going on in the monetary realm and saying, boy, there's a ton of innovation. There's a ton of changes to the way money behaves and what money is. We ought to really stay on top of these things because, maybe they could be quite important. Maybe even this has something to do with the fact that consumer prices seem to be completely out of control. And as everybody knows, even though at the time it was more controversial, but inflation, real inflation, is a monetary phenomenon. Maybe we should connect these two things, this gross monetary evolution, this proliferation of offshore monetary capacities, with what's going on, not just in the U.S. economy, but also throughout much of the rest of the world as well.
The 1970s. I'm going to read a quote from the mid-1970s here by Richard Debs, and it reminds me of another piece from that exact same year, if I remember correctly, The Case of the Missing Money. Maybe it was 1976, 76. Stephen Goldfeld or Goldfield?
Goldfeld, yep, 76.
Goldfeld. And you know what Goldfeld did and what Debs does here? It seems so much more scientific. They admit they don't know. You don't hear that very often in today's monetary scholarship. Everyone...
That's the Volker myth, right? That's the idea that we don't need to question central bankers because they must know everything about money. Therefore, we'll just let them work out all of this stuff. When in fact, the quote you're going to read, you're going to find out that that was never the case.
I love it because they say, hey, I looked into this and I don't know. Maybe we need more people looking into it. You don't hear that these days. Okay, here we go. Richard Debs, the Federal Reserve Bank of New York's chief administrative officer at the time. Finally, for the sake of logic, I should mention the legal framework of the Eurodollar market, since I included the Eurodollar market in my working definition of international banking from the point of view of the United States. However, I'm afraid that I can't do much more than just mention it. The Eurodollar market itself is not easily definable, and its legal framework, if any, is even less so. The market grew rapidly without the assistance or burdens of an integrated or even coordinated set of laws. It is an international or multinational or transnational phenomenon, but it is regulated only to the extent that the Eurodollar activities of the institutions operating in that market, the Euro banks, are subject to regulation and supervision by the national jurisdictions in which they operate. Complex system, networked, adaptive, self-organized. It makes me think of the Suffolk system too, how it's self-policing. Your thoughts, Jeff?
In theory, it's self-policing. And really, I mean, there's a couple things here. Number one, that quote was, 45 years ago. So if it was ununderstandable and unimaginably complex in 1976, you can only imagine what it looked like, or maybe you can't imagine. That's really the problem. You can't imagine what it looked like 30 years later in, say, 2006, and what it might look like today. So that's really the challenge that we have before us. It's a challenge that, because of the Volker myth, that central bankers and economists have decided they don't want to take up, it's left for the rest of us to try to fill in these gaps because, like it or not, this is the way the world actually works. And again, reiterate our point here that before the Volker era, there was actually some legitimate and engaging scholarship about the Eurodollar system that even today is quite useful in us understanding what, at least how it started and how it got going and how it got really sizable and big. And then we can sort of go back in our own, through our own scholarship and fill in the gaps about what happened ever since 1976. And then, of course, the big one in 2007 that started to reveal all of those fascinating and really incredible developments over the decades in the middle, where central bankers and where economics in general didn't care about any of these things.
If one was to start doing monetary scholarship right now, if one was to attempt to define and identify and measure, map the creation and distribution of money, credit, and collateral, one could do a lot worse than starting with the Treasury International Capital report, which we go over often enough. It's 2 months behind the times, so right now we're going to be looking at July's end, and we started talking about the Caribbean, and we're going to start with the July tick report with the Caribbean system. I'll pull up a graph.
Yeah, what we've seen ever since last year, late last year, is that banks, I'm going to use my scare quotes here, banks in the Caribbean have said, we don't want to do this dollar stuff anymore, and they've been cutting back. And what you're seeing here is the tick data captures cross-border relationships and transactions and balances and levels and flows and all sorts of other things. And this is part of that, where the tick data is saying banks that are located in the Caribbean, so these are offshore entities, are doing fewer US dollar transactions with both with U.S. banks, U.S. located banks, which includes foreign subsidiary or U.S. subsidiaries of foreign banks as well. So any U.S. bank is considered a U.S. bank, even if it's a foreign bank that happens to be located in the U.S. as a subsidiary of an overseas parent, which makes it even more complicated because usually some of this tick data captures transactions between that U.S. bank, which is a foreign subsidiary or U.S. subsidiary of a foreign bank, transferring money back to its parents overseas. So you have all sorts of complex, as you pointed out, Emil, complex systems. Whereas, the Caribbean, as we started out talking in this episode, the Caribbean has always been a very major node in that global monetary network. So when we see things happening in these Caribbean banks, it means something. It can mean potentially something substantial. That was certainly the case in May 2011, where Caribbean banks had, by and large, sort of bypassed the 2008 crisis. At least there wasn't any drop-off in activity even during the 2008 crisis. But in 2011, in that second Eurodollar crisis that erupted, suddenly the Caribbean banks were no longer expanding, certainly, but which largely meant that the system itself was undertaking some form of radical transformation, which became a deflationary monetary squeeze that didn't really end.
And so right now we see the peak in March 2020, and then now you're drawing our attention with the red arrow to December 2020, and that it's only gone lower ever since. One of the things that I love about this data is that you can identify the nodes and then observe that they operate differently, that they had different perspectives. So we've had 4 Eurodollar crises, and these nodes turned themselves off or malfunctioned or stopped growing at different points. We've got the United States node, the Caribbean, Europe, and Japan. The Caribbean in May 2011, Eurodollar number 2, the European sovereign debt crisis. Now let's go to Japan, Tokyo, the leader of the Asian Eurodollar. They blew right through 2008, right through 2011. The world was going to continue to be one of growth and expansion, especially because China was never going to stop growing, and they were there to fund them until when?
Till right around 2013, 2014. That the fun with the Shanghai Chori solar corporate defaults started to happen. All those other things. The Japanese were sort of understanding the situation as it was evolving in China and how the dollar or the Eurodollar was finally catching up with the Chinese story and sort of got ahead of it. And so the Japanese, while they were still doing more dollar activities largely with China, borrowing and redistributing dollars through Tokyo, they were at least somewhat wary about this transition, this post-2011 transition, and starting to think ahead. And of course, thinking ahead got them to 2017 when they said, especially after the 19th Party Congress, something's really different here. China is not the same China as it was before. And we've done this before. We've laid much of the early part of Eurodollar number 4 in 2018 at the doorstep of Tokyo banks, and the tick data sort of backs that up. And then so you fast forward to 2020, late 2020, early 2021, and suddenly you see the Japanese banks kind of doing the same thing as the Caribbean banks were doing during this year, which is supposed to be the most reflationary year maybe ever.
And now you're showing the combined total, basically, of claims on foreigners.
Yeah, this is the U.S. banks and what they've lent in U.S. dollar, various U.S. dollar instruments to the offshore world. So that's claims on foreigners.
And you can see the peaks and valleys of the Eurodollar squeezes and the reflations. And now we zoom in.
Emil, isn't the biggest part of that chart is like the U.S. dollar exchange value? Look at where it stops, right at Bear Stearns. In early of 2008, yes, there's peaks and valleys since then, but it was on a parabolic trajectory up until then, and then all of a sudden it stopped. So everybody talks about, the Fed's printing money and bank reserves, and there's been, the post-crisis has been great for banks. The Fed's bailing out everybody and paying off Wall Street. Well, no. When you look at the actual monetary system, certainly the offshore monetary system and something like the tick data, and it's not just tick. We see this time and time again all over the place. It's really been that pre-crisis story ended at Bear Stearns, and ever since then, even if some of the peaks are higher than the previous peaks, it's still not the same as growth. This is not monetary growth. This is, sideways is contraction. Even slightly growth is contraction. We live in a nonlinear world. So the lack of growth at the same rate is the same thing as contraction. And when you see lack of absolute growth, that's a serious, serious problem.
We zoom in on the next graph to the most recent 2 years, and we see that since April 2021, this graph, we're on the downslope of this mountain slope here right now. So it's suggesting not reflation, not recovery, not acceleration, at least by this one measure.
It's certainly not a flood of US dollars, as Jay Powell said in 60 Minutes last year, right? And that's, the theme in the mainstream media so far as that goes is that there's too much money this year. Reverse repo, there's 1.3 trillion now at the reverse repo window. So obviously there's too much money, and the world's biggest problem is an inflationary too much currency situation when that may be the case of bank reserves, but bank reserves are not functional money. And as we said at the outset here, this offshore stuff has been the basis of really how things get done in the real economy, the real global economy internationally for more than a century. So for at least the last half century, this is the way it almost exclusively gets done. So this is the money that you need to look at. And it's not, what we're showing you here, the tick data, it's by no means comprehensive either. It's a good slice of what goes on, but it's missing a whole bunch too, because the Treasury International Capital report was never set up to tell us about the Eurodollar system. It was really set up to kind of track some of these asset flows that go back and forth, sort of acknowledging in the late 70s that, there's stuff going on offshore. Maybe we want to keep track of some parts of it.
In a previous episode, we talked about the Asian financial crisis and how that was the first time this data set reflected a net selling of long-term domestic US dollar securities. And that it turned out over the following 20-some years that was a warning, a symbol, a sign that something's wrong in the monetary system. Well, we talked about that because I believe in May we registered another negative. Bad news. Jeff, for July, you're reporting we see yet another negative. Extra bad news.
Yeah,
Concern.
So we have that. Well, let's explain what we're talking about here. This is the net transactions, the foreigners who buy and sell US dollar assets, as you just said. And so what we're saying here is that there's a direct and obvious correlation between monetary sufficiency and the ability of foreigners to buy US dollar assets. As the pre-crisis period, the world was flooded with Eurodollar capacity, which meant foreigners had additional dollars in their hands that they repatriated back to the United States, and repatriate's the wrong word, that they used then to buy domestic US dollar assets. So when you see the Eurodollar system is expanding, creating a sufficient amount of monetary capacity, one of the symptoms or one of the consequences of that monetary capacity is that foreigners end up buying a lot of US dollar assets that the Treasury International Capital report can pick up on. Unusually, if the Eurodollar system turns constrictive, there's not enough money. What that usually means is that foreigners buy fewer US dollar assets on net in any given month. And in more extreme situations, they're actually forced to sell on net US dollar assets. So we're making a couple of assumptions here, which is that when foreigners have to sell US dollar assets, that must mean something is not right. Something's very constrictive in the Eurodollar system. There can't be enough money flowing outside the United States. Otherwise, foreigners would be buying US dollar assets with these Eurodollars they ended up holding. So if they're selling US dollar assets, whether it's public or private entities, that's a warning sign. It's a consistent, reliable, historically established warning sign. As you mentioned, going back to the Asian financial crisis and even before, when the Eurodollar system is creating dollars, foreigners buy US dollar assets. When the Eurodollar system is not creating dollars, foreigners sell US dollar assets, which is what has happened in 2 out of the last 3 months in TIC. So May and July.
Which is troubling and concerning, at least something we need to keep our eye on. You raise 3 more items that we need to keep our eye on in a second article, a follow-up, which was also posted at Alhambra Investments on the 17th of September. The title of this one is Practical Remainders and Reminders. Rapid fire, Jeff. Let's go with number 1. you observed something in China, Treasury holdings in China and Belgium, and you compared it to the action of the CNY, the renminbi, the yuan, and you found what?
There's usually a pretty good correlation there too. And when dollars are not flowing into China, CNY tends to be weak, which is the other half of the rising dollar. And what we've seen ever since earlier part of this year, treasuries are disappearing from mainland China as well as Belgium as a proxy for Chinese transaction derivative markets with Euroclear. They've been dropping. Yet, ever since the end of June, CNY has been not perfectly, but is traded in a very narrow sideways range, which contradiction sort of with what we're seeing in the tick data, which kind of suggests some money business or monkey business going on in the money business, stealth transactions, PBOC, that kind of stuff. So tick data says CNY should probably be weaker than it is, and it's not. It's in fact almost going perfectly sideways.
Point number 2, there's a blip on the radar screen, this time coming from private net activity as reported about US dollar corporates. So we see a negative for the first time since last December. Tick shows a sharp drop, meaning on net, more corporate securities were sold than bought.
Yeah, and this is corporate bonds, not equities. So, but you know, the corporate part of the Eurodollar story was a big part of Eurodollar number 4 for collateral reasons, junk bonds, all those kinds of, Euro bonds, things like that. So, we knew that Eurodollar number 4 was starting to get serious because of the collateral element to it that, hurting people in the treasuries and T-bills and stuff like that because of the foreign rejection of US dollar corporate assets during late 2018 and into 2019. Now, that turned positive last year where foreigners started to buy up a lot of U.S. corporate bonds again, which is consistent with the idea, hey, the pandemic's behind us. There's a lot of growth potential if we believe in central bankers and economists. So let's buy U.S. corporate bonds again. And so that happened late last year into early this year up until around, the middle part of the year where some of that buying appetite kind of fell off. And then for the month of July, we have now a negative for the first time since last year, which is not nothing. It's not potentially nothing huge, but it's one of those things you put in the back of your mind, put it on the back burner and say, we might want to have to revisit this down the road because potentially it could signal, not just for collateral, but just for general purposes, that something is, some risk aversion has developed, some serious risk aversion has developed offshore.
Our final blip on our monetary radar screen comes from the official sector, where if they're buying long-term debt securities, that suggests the Eurodollar system is growing. If they're selling, it could mean that they're trying to send a message to Uncle Sam to stop its profligate ways, or there's a currency Pearl Harbor in the making, or maybe they need to subsidize their local banking systems with the dollars they do have, and they're selling them on net, the Treasury securities. So those are some of our possibilities. What did we see in July from the official sector?
Yeah, they don't really sell because they hate Uncle Sam, do they?
What?
The official sector tends to sell U.S. Treasury securities when they have no other option. And it has nothing to do with Uncle Sam. It has everything to do with these offshore monetary conditions. And so, especially going back to 2012 and really Eurodollar number 3, 2014, the official sector, largely the Chinese, but not always the Chinese, they end up selling treasuries to try to fill in their Eurodollar hole. So when we see the official sector sort of, start to sell, especially U.S. Treasury assets, it's another signal that they're starting to get worried about because they're acting upon what they see as U.S. dollar inadequacies in their local jurisdictions. And what we've seen over the last couple months is that there was reflation in that sort of trend. U.S. Foreign official sectors were buying U.S. Treasuries on net earlier this year, which was sort of reflationary. I know it's backwards from the official story where they're supposed to be selling when they're buying and they buy when they sell and all that stuff. So they was buying by the official sector when U.S. Treasury bonds were selling off in January and February, because that meant both of those things actually meant reflationary conditions, more dollars, or at least less of a constrictive offshore environment. But ever since the middle of this year, consistent with pretty much everything we've been talking about, suddenly the official sector is starting to sell a little bit more than they're buying, which is indicative of not crisis level trouble, but things moving in the wrong direction, the deflationary direction, an indication that the Eurodollar offshore system is experiencing a little bit more trouble than not.
In part 2 of this episode, we're going to talk about the biggest news in macro, not Evergrande, but that Fed's taper, which rhymes with paper. And we're going to look to a monetary measure, swaps, to see if what they thought of this. Swaps rhyme with flop. So that's the clue. Come right back.